I'm Jeff Klingelhofer, co-head of investments at Thornburg Investment Management. For quite some time, our team has contended that goods inflation is indeed transitory. While the slowdown has taken longer than we originally thought, goods inflation is indeed falling. However, the Fed's chicken and egg dynamic of inflation first before rate hikes has them playing catch-up quite aggressively. The headline-grabbing data points over the past few months are encouraging and now tell a story of retreating inflation. Although CPI slowed down from 9.1% year-over-year in July to 6.4% year-over-year in January, the Fed still needs to keep their foot firmly on the brake. Slowing inflation is just one part of the equation. While the Fed's success may allow them to moderate their pace of interest rate hikes or eventually hold rates at a high level, Chair Powell and the rest of the Fed must also work to restore credibility. In fact, Chairman Powell reiterated his message that inflation remains a ways off from where they need to see it, and there's more work to do, even as the Fed slowed its tightening pace in February. Inflation peaked last year in July. Since then, we've experienced a slow and steady decline in the headline number. We've also seen services inflation taking an increasing share of the price pressures and goods inflation taking a decreasing share. As I've argued, this is important in terms of the Fed's third mandate, which I believe will determine the timing of the central bank's pivot. If services inflation remains above 2%, though lower than where we see it today, and goods inflation keeps shrinking, the Fed may tolerate core inflation above 2%. Given that services inflation is heavily driven by rising wages, and today much of this increase is focused on the lower income population, the Fed views this as good inflation. For some time, I've argued that the Fed's third mandate is one of social stability, or more succinctly, compressing the wage gap. Chair Powell and the Fed's race to cross the 2% inflation finish line is made more difficult by the strong U.S. economy headwinds blowing in their faces. Imagine also trying to do this while wading through a flood of government spending, stemming from December's omnibus spending bill. In other words, this battle against inflation is at odds with the easy fiscal policy crosscurrents. Unsurprisingly, I think it will be more difficult for the Fed to go from 6% to 2% inflation than it was to shed the excesses from 9% to 6%. The silver lining to all of this is that a tightening Fed means that yield and income is finally back. Investing in T-bills or two-year treasuries won't provide a better economic outcome than investing in areas which investors can earn a credit risk premium. For a while now, we've suggested that the economy will be more than able to perform into higher rates. However, we also have said that our belief is that there is a thing such as too high of rates to sustain the current growth rate. We think that about 3.75% or so is roughly fair value on the 10-year Treasury, and we're opportunistically adding protection with Treasuries when rates rise above this level and taking duration lower when we've seen rates notably below this level. We work to carefully balance the opportunity in both credit and rates and expect that volatility will remain high throughout the remainder of the year. Away from rates, all the talk about an imminent recession has pushed spreads notably further above treasuries in most areas of the market. Given the ongoing strength in the consumer, we continue to believe that the best relative value on a sector level continues to be within securitized debt. These non-agency asset-backed securities spreads on the AA to BBB rating spectrum are wider than investment-grade corporates with similar ratings. Although this is generally the case, today's premiums are wider than usual. We favor asset-backed securities and residential mortgage-backed securitized credits, which provide additional protection in the form of not only fast paydown, but also being secured by the underlying collateral to provide some ballast when, not if, we enter the inevitable recessionary environment. We prefer prime borrowers through bonds backed by consumer loans and autos because subprime consumers are much more sensitive to the evaporating stimulus and the heightened pressures of inflation. When we elect to take on subprime exposure, it's because we believe the bonds are senior in the capital stack, and these bonds tend to pay down very quickly. Many investors also ask about emerging market debt. We are cautious and selective in these spots given the inherent high levels of global risk. But slowing U.S. growth means emerging market differentials are more favorable in 2023, and an eventual pivot from the Fed will slow the rise of the dollar. In terms of credit quality, we favor investment-grade corporate bonds over high-yield corporates. In an environment of weak growth, we're weighted towards non-cyclical names, areas like utilities, healthcare, select tech names, and high-quality financials. We won't close the door entirely on high yield, as 7 or 8% would capture any investor's attention. But as with emerging markets, we pair a robust, bottom-up fundamental process with a top-down view, and we're highly selective in our approach. Looking ahead, we still see some red lights on the dashboard. Few investors have weathered an inflationary storm like this, and the inflationary environment last time was dramatically different. The last decade's game of monetary and fiscal stimulus has had a profound effect on the global economy, and without a playbook, it's hard to predict how this experiment may end. Today, caution is the only rule, and we believe we're well positioned to capture both yield today and remain defensive.